Breaking, listen up, retirees and seniors, because this just changed. And if you are 65 or older, this is something you need to hear right now. A brand new federal tax rule could give qualifying older Americans an extra $6,000 deduction. And for some married couples, that could mean up to $12,000 off taxable income. But here is the big warning right at the start. This is not a $6,000 check, it is not a new stimulus payment, and it is not automatic cash sent to your mailbox, so please do not let the headlines fool you. This is a tax deduction, and if you understand how it works, it could lower your tax bill and keep more money in your pocket. Are you a retiree? Are you living on Social Security, a pension, IRA withdrawals, or retirement savings? Did you know about this? Because a lot of people still do not. And if you miss the details, you could miss out on money you legally qualify for. So stay with me, because I am going to break this down in plain English, step by step, and tell you exactly what retirees must know right now before it is too late. Here is the simple version. The new rule allows people age 65 and older to claim an extra $6,000 deduction on their federal taxes. If both spouses in a married couple are 65 or older and they file jointly, that can be up to $12,000. And this extra deduction is on top of the deduction seniors already get. That means this new rule can stack with the regular standard deduction and the existing extra deduction for being over 65. That is why people are calling it a senior tax bonus. It is an added break for older Americans. But again, and this part really matters, it reduces taxable income, not taxes dollar for dollar, and not everybody will get the same benefit. So if somebody tells you every senior is getting a $6,000 payment, that is not true. You need to know the real rule, not the rumor. Now let's talk about who qualifies. First, you generally need to be age 65 or older by the end of the tax year. That means if you turn 65 during the year, you may still qualify as long as you hit that age by the last day of the year. Second, income matters. If you are a single filer, the full deduction is available up to certain income limits, and if you are above that, the deduction starts to shrink. If you are married filing jointly, the same thing happens, but the numbers are higher. So yes, this is real, but no, it is not unlimited. The full bonus starts phasing out above $75,000 in modified adjusted gross income for single filers and above $150,000 for married couples filing jointly. And the deduction gets reduced by 6 cents for every dollar over those amounts. That means if your income keeps rising, the deduction keeps shrinking, and once income reaches $175,000 for single filers or $250,000 for married couples filing jointly, the extra deduction is fully gone. So let me say that clearly. If your income is lower or moderate, this rule could help you more. If your income is much higher, you may get a smaller benefit or none at all. That is why retirees need to check their numbers now, not later. And here is another huge point a lot of people are missing. This deduction is available whether you take the standard deduction or itemize. That is a big deal. In simple words, you do not have to itemize to get this extra senior break. If you take the standard deduction, you may still be able to claim it. If you itemize, you may still be able to claim it. That makes this rule more useful for many retirees than people first thought. Now let's get to the question everybody is asking. How much money can you actually get? The answer depends on your income and your tax situation. This deduction can lower the amount of income the government taxes. So the actual savings depends on your tax bracket. It does not mean every person saves $6,000. It means up to $6,000 of income can be deducted per qualifying senior. For some people, that could mean a few $100s in tax savings. For others, it could be more. For a married couple, both over 65, the benefit could be bigger because the deduction could go up to $12,000 total if they qualify. But here is the warning you need to hear. If your taxable income is already very low, or if other deductions already wipe out most of your tax bill, then this new deduction may not help much, and in some cases, it may not help at all. Why? Because this is a deduction, not a refundable credit. It can lower taxable income, but it does not by itself create a refund if you do not owe tax. So yes, this rule is important. Yes, it can help, but it is not magic money for every retiree. You need to know that before it is too late. And here's another thing retirees must understand. This new rule does not mean Social Security is no longer taxed. I need to say that again because there has been so much confusion online. This deduction does not rewrite the basic rules for taxing Social Security benefits. It does not erase those rules. It may reduce your overall taxable income, and that can lower your final tax bill, but it is not the same thing as ending taxes on Social Security. So if somebody told you, good news, Social Security is now tax-free, please be careful. That is not what this rule actually says. Now, how long does this last? This is also urgent because the rule is temporary. Right now, it applies for tax years 2025 through 2028. That means this is not something you should assume will be around forever. Congress could extend it later, but as of now, retirees should treat this as a time-sensitive tax break. In other words, you need to plan while it is here. So what should you do next? First, do not ignore this. If you are 65 or older, look at your expected income. That includes Social Security, retirement withdrawals, pension income, part-time work, interest, dividends, and any other taxable income. Second, check whether you are single or married filing jointly, because the income thresholds are different. Third, if you are close to those phase-out ranges, pay attention. Even small moves in your income could change how much of the deduction you actually keep. For example, a larger IRA withdrawal, a Roth conversion, selling investments, or extra work income could push you higher and reduce the value of the deduction. Fourth, make sure your tax return includes the right information, including the Social Security number for the qualifying individual, because that matters for claiming this break. And fifth, if you use a tax preparer, CPA, or enrolled agent, ask them directly about the new senior deduction. Do not assume they will bring it up. Ask the question. Say, do I qualify for the new $6,000 senior deduction, and how much could it save me? That one question could put extra money in your pocket. If you do your own taxes, watch for updated forms and software instructions because this is a newer rule and filing details matter. Now let me talk to the people who really need this the most. If you are on a fixed income, if every dollar matters, if you are watching grocery prices, medication costs, utilities, rent, and property taxes go up, then this is exactly why you need to pay attention. Even if the final tax savings is not a full $6,000, a lower federal tax bill can still help. A few $100s matters, $1,000 matters, keeping more of your own money matters, but you only benefit if you know the rules and act on them. And let me give you one more warning. Do not fall for scam messages, fake tax helpers, or social media posts claiming there is a secret application, a special senior payment portal, or a fast way to claim your $6,000 bonus now. Be careful. This is a tax deduction claimed through your federal tax return, not a surprise payment program. No one should be asking for your banking login, your Medicare number, or upfront fees to release the money. If you see messages like that, slow down and double check before you do anything. So here's the bottom line. Yes, the new $6,000 senior tax bonus rule is real. Yes, it could help millions of retirees. Yes, for some couples, it could mean up to $12,000 in extra deduction. But no, it is not a direct check. No, it is not automatic cash for every senior. And no, it does not end taxes on Social Security by itself. The people who win here are the people who understand the rule early, know whether they qualify, and plan ahead before filing season catches them by surprise. So ask yourself right now, are you 65 or older? Is your income within range? Are you filing single or jointly? Are you talking to your tax preparer? Are you making moves this year that could raise your income and shrink the deduction? Those are the questions that matter. This could put extra money in your pocket, but only if you know what to do next. So do not wait. Check your income, review your tax plan, talk to a professional if needed, and make sure you do not leave this deduction sitting on the table. If this video helped you understand the new rule in plain English, watch till the end, hit like, drop a comment, and tell me, did you already know about this new senior tax break? And share this with a retiree, parent, grandparent, neighbor, or friend who needs to hear it today, because this is one of those tax changes that sounds small in a headline, but could make a real difference when it is time to file.